Okay, guys, ladies and gentlemen, welcome to another enlightenment episode of Passive Investing in US Multifamily Show. I'm your host, Jefferson Ortiz, and I'm here alongside my co-host, Jonathan Ortiz. In this podcast, we team up with passive investors to explore the world of multifamily real estate in the USA, specifically for Canadians that may want to invest in the USA, specifically in the Sunbelt region in Midwest. Today, we have a remarkable guest who is a true titan in the multifamily real estate industry. He's none other than Dr. David Iggy, Iglewicz. I don't know if I said that correct, but Dr. Iglewicz brings with him a wealth of experience, not only in the world of real estate, but also in leadership and development. Iggy's journey is unique, having started a pediatrician dentist and later making a significant mark in the multifamily real estate sector. He is the co-founder and managing member of Lake City Equity, a company that focuses on multifamily real estate investments. What's truly remarkable is that he has successfully managed over $250 million in assets. So we're eager to learn more about his journey, insights. So please join us in extending our welcome to David, aka Iggy. Welcome.
Oh, thank you. Thank you guys for having me on. I super appreciate it. I love this stuff and I just want to, share my message with more people. So really appreciate it. And hopefully I can add a tremendous amount of value to you and also everyone else who's listening.
No, thank you. Thank you for your time.
Yeah, Mr. Iggy, we just wanted to say, super excited to have you on board. To kick things off, could you share a little bit about your early life and what initially led you into the multifamily real estate industry?
Now, how early are we talking? We going way back? Or we
Hey,
going
wherever you want.
We'll start in dental school. So there was a lot of learnings, and you tell me if I'm talking too much because I get excited. And so you just cut me off. And so I'm in dental school. It's now, let's say it's 1999. I guess it's my second year of dental school. And I see a whole bunch of people investing in the stock market because it was, when you had an IPO and it just went through the roof in 1999. And so that was the first little lesson because a lot of fellow dental students were investing in the stock market and seeing their money multiply really quickly. Well, they got greedy, as it did everybody. And the money they were investing, a lot of it was student loans. And so they fell short when that hit. And so that was the first time I saw people really hurting financially over an investment mistake. And I was like, those kind of things stick very vividly in your head. So that was number one. Number two, I'm getting to the multifamily piece, I promise, but all this is relevant to today. And number two was, I'm already now a pediatric dentist. I'm practicing. Everything's going well. I start seeing signs that there's hiccups in the market. It's 2007-ish. And then in 2008, I think it was winter 2008, I'm at a dental meeting and I see a whole bunch of dentists that, already retired having to go back to work and their faces were just pale and it was horrible. I never wanted to see that again. And I really made it a mission. How can I solve this so this doesn't happen to them again? So that was in the back of my head. I'm a slow learner or a slow processor, but believe it or not, I'm a fast initiator. And so I knew I had to take action so this wouldn't happen again because all of them invested. Now this is two lessons. All of them invested in the stock market, in the normal stuff, because as dentists and medical professionals, we're trained just to stay the course, to do everything how it's supposed to do or how it's supposed to be done. And then everything will work fine. And we've seen that's two times that I saw it really hit hard. Then later in 2009, back then our 401ks only came every quarter and it was a piece of paper certificate. And I pulled it out from the mail and I looked at it and I was like, these numbers have to be wrong. So my 401k truly turned into a 201k. I mean, it was cut in half. It was probably, maybe 45% of the value. It really went down. And I was like, this isn't good. And, I'm younger and I'm still working. And so I didn't see my income take much of a hit. but you saw the whole economy take a hit. I had patients wanting to pay for services with gift cards, and obviously you're a pediatric dentist, you're like, don't worry about it, I'll just do the work. But those are the kind of things that you saw during that time. And so you knew that was affecting everybody. So fast forward, we're going to super fast forward, and we're going to make it now. It's about 2015, 2016. I have an advisor at the time, and I asked him, hey, I want to retire. And it was just a hypothetical. How many years could I retire with this, the savings and the investments that I have? And he's like, well, you can't. And I was like, no, I mean, is it 1 year, 10 years, 20 years? Like I had a number in my head based on, all this stuff. And he's like, well, I have to work on it. I'm like, work on it, come up with a package. So he works on it, comes up with a package. And basically it was like, at this income level, you had 8 years left. I'm like, 8 years with all that? That doesn't make sense. And so it started everything moving. I'm gonna backtrack a little bit. My dad was a professor at Temple. He came home one day, and he was from Russia. That's also why the last name Iglewicz is like, tough to pronounce. That's why everyone calls me Iggy. But he was from Russia and, transferred over here. So he was an extremely hard worker, and he believed in hard work. He valued his students, especially the ones that got A's. Well, he taught this executive MBA program, and this one student was always happy and just fun-loving, just enjoyed himself, but was a C student. Does this sound familiar to like all these real estate investors, right? And, but he was just kicking butt back then. And this was probably in the early 2000s, several $100 million of assets, and never got his name. But my dad came home and he's like, you won't believe it. This gentleman, he's a C student. He's like one of my worst students, and he's worth the most, and he's having the most fun. And I'm like, Dad, doesn't that mean something? Oh no, he got lucky. So that was always in the back of my head. And I value my dad's opinion highly. And so, but that was always in the back of my head. That's the way to go. Having fun, making money, and making other people happy. I mean, so that was, a great way of looking at things. So that's what those kind of things fast forwarded me into multifamily specifically, because it related, especially the C-class properties. Those are the patients that I take care of. And so I could now take care of them at home, and we take care of our residents, and we want to provide value to them. And so it was like this full picture. And not only that, but we could take care of other dentists by helping them invest specifically in these deals where you're taking care of basically your patients' families and making money at the same time. So there's the story.
Wow. No, so much to unpack here. I wrote a whole bunch of notes because there's definitely a lot of things I wanted to touch on. So just to start off, because for the audience that may not know, where is home for you? Where did you grow up, and where do you reside currently?
Okay, so I grew up in New Jersey, in the southern part of New Jersey, and you might hear a little bit of a Boston accent because there were 2 years that my dad moved us to Boston so he could teach up there. And so that's where the Boston accents, you'll still hear that. So we currently reside outside of Philadelphia, Pennsylvania. And so I don't know if anybody's familiar with that area.
Yeah. No,
well, the Philly fans, I'm kidding. Yeah, because everyone hears about the Philly fans. That's why. And the cheesesteaks. Yeah.
No, that's awesome. And definitely, and it sounds like along your journey, along your life, you had a bunch of little tips, what do you call it? Like, I guess, I know Rod calls them webinars, right? So you had a lot of episodes where you noticed there was all these other asset classes, but none of them were really going to be able to provide that financial freedom or provide that what you had in mind. So that's really interesting, and it's interesting that you took note of that. Even the story that you were saying about your dad telling you that, right? Like, it's little things like that stick in your head and then allow you to make the right choices later on. So that's really interesting. Anything you want to add, John?
No, that's awesome. It's been amazing. Definitely hearing the start of of that investment journey and your life and your career path as well. I wanted to dig a little bit deeper into a pivotal moment that led you into the transition from pediatric dentistry to multifamily real estate, essentially.
Well, we're going to get deep. And so, and I hate to bring this up, but you want to know really what it was. And I always think about, what it was. And my parents had a beach house in New Jersey, in Margate, and it was summer of 2015. And my dad was sick. I knew he was really sick, but I didn't, you don't really accept it. And he was jaundiced, like he was like all orange. And he's like, David, let's go for a walk. And I'm like, can you? And he's like, yeah. And he struggled, but we went for a walk on the beach, and he was my mentor. And he was like the rock that held our family together. And he put his arm around me. I'm on his left, he's on the right. He puts his arm around me as we're walking, which is a rarity. Like, he would hug me and stuff like that, but it was a rarity that he did that. So I knew something was up, and he said, I'm really proud of you. And really hit me, because at that time, I wasn't proud of myself. Even though everyone on the outside saw me as this big, accomplished pediatric dentist. I had 2 wonderful kids. I have a wonderful wife. Everything seemed perfect on the outside, but I wasn't fulfilled. And I felt like I wasn't carrying out my mission. I wasn't as entrepreneurial as I wanted to be. And so I felt like I was failing him. Now, did I say that to him? No, because that was our last walk, and it stuck with me. So I promised myself that day forward, that I was going to be the person that he was going to be proud of.
Wow. No, that's deep. Like you said, that is very deep, and it's definitely sounds like it was a very huge moment for you. And I think this real estate multifamily syndication, it is one of those businesses that you have to have a strong why, you have to have a strong reason, because you're going to want to fail. We've definitely been in there where we wanted to just give up. In our case, basically educating Canadians to invest in the US is a big hurdle that most people have to get through, right? You have to educate them, why the benefits, what parts of the US are beneficial and so on. So, but we have a strong why. So that's really important. And that's very meaningful.
Thank you for sharing that, Iggy. That was definitely touching there.
We've kind of got to learn a little bit about you, Iggy. Tell us a little bit about your first multifamily deal. Tell us a little bit about that as we're transitioning here.
I'm trying to think. You want to hear the first passive investment. And so at 2015, now I'm trying to be active. And as with everything I've done, you think you can do this by yourself. How hard could it be? And as everyone knows, it's very, very difficult. I don't care if you buy a 4-unit or a 5-unit by yourself or a 100-unit by yourself. There's a lot of legwork behind it and a lot of moving parts. And so I tried several times on getting deals that made sense, that would actually cash flow right off the bat, with no training, just learning by myself, watching YouTube, reading books, educating myself. But there was no structure to it. So the deals I was finding, the cash on cash didn't make sense. So you're talking about like working really hard and getting a 4% return, like year 1, year 2, year 3. And I'm like, this doesn't make sense. So I'm like, how about I invest passively with another operator, and let's see how that goes? Because now you're getting a higher caliber operator than you are, because you're just starting, and they know what they're doing, and let's go from there. And that was the best decision I could have ever made. I mean, well, I'm going to tell you why, because I was trying to be the guinea pig for other dentists too. And like, if I do this and it works, you guys should do it. And it was COVID, and it was end of March 2020. And in Pennsylvania, no dentist could work. You really had to shut down, or at least that's what they told you to do. There were some that worked and they were helping out patients, but most people you weren't allowed to work. Most dentists, you weren't supposed to work unless it was an absolute emergency. And so with that, what ended up happening was my stocks went down in value. My bonds, I had muni bonds that were supposed to be, no matter what, they were paying, dividends because municipalities would pay. They did pay out their dividends. What ended up happening, though, the value just dropped because everyone was selling everything they could to invest back in the stock market. So you had those two things going down, was making no money doing dentistry because obviously we couldn't work. So what did I have coming in? I had the freaking distributions from those passive investments in multifamily, and those were coming in, and those were the only things that were paying me. And I am forever grateful that I made that move, because for me at the time, it was a high risk move because I was wiring money, big funds of money that I never did before. And so it was the first step to get it done. And I think that that's where a lot of people get held up. They have all this money sitting in bank accounts or stock accounts, Schwab accounts, Vanguard accounts, whatever they are. And it's sitting there. And those advisors that they have are moving money all the time, big money. When it comes to you actually pulling the trigger or pressing the button to send the money, all of a sudden the pressure's on you because all the responsibility's on you. And that's the mindset that we all need to get over, as passive investors, is you got to hit that button. You got to take control because the other people have other missions. You're going to take care of your money probably the best. And you're going to at least be the most responsible, as opposed to somebody else having to take care of a whole bunch of other people's money. So there you go.
No, that's really great. And you touch on some good points, especially because even it has happened to us. This is how we got started. It's a little bit of a passive investing. But then what's really important, I think, with the passive investing is that obviously you have to have a strong team that you can rely on, right? Because obviously as a passive investor, you're relying on the GP team, you're relying on the experience, the track record, their expertise. So it really comes down to the team, I would say, more than anything. But that's really interesting. So you did have a good experience when you invested passively, and you're like, I'm not doing anything and I'm still getting the stocks and all these other assets.
Especially during a rough time. So that's great that it was giving you a return. Multifamily is definitely one of the best asset classes during bad economic turns. So that's great there.
And then so that was your first deal as a passive. Now tell us about your first deal as a GP, which I imagine came sometime after that. Tell us a little bit about that.
Well, there were several that came all at once, and that's what usually happens. And so I'm going to mention this one, even though it wasn't like the first one. I worked with a group that was basically out of New Jersey, and it was DeRosa Group, and it was July of 2020. And it was an asset in Winston-Salem, North Carolina. And it was just, first of all, it was exciting because you're now part of a general partnership team. You saw that this was an apartment building that was in a good area, but it wasn't taken care of. There was no love given to it.
You're starting to understand things a little better.
Yes.
Awesome.
And so you go down there and you see all the value that can be created, and you see what the rents are, where they should be, and you see just everything unfolding in your eyes. And that ended up fantastic. I mean, we did a refi, like 40% cash out, 40 or 50% cash out for the investors.
Wow.
And, we basically doubled the value. I think we paid $18.5. And I think it was appraised close to double that when we did the refi. So, I mean, and that's where you see the power. And then you continue those distributions, and that's where you really see the value you provide for, investors and everybody else. And yeah, fortunately, that was a great first general partnership, or one of them.
Absolutely. And I mean, just to hear you talk about some of those numbers, right? Like you're able to refi, get 40 to 50% of the investor's capital back out, and then you're able to keep this asset, but now it's valued, like you mentioned, 18.5, almost double that. Like it's incredible what you can do with multifamily. I personally don't know any other asset class where you can do this, right? Where you can implement those increase in the rents, operating it better, managing in a more efficient way, and be able to do something like that. Like that is phenomenal.
That's
Now,
amazing.
in this team, what would you say was your role? Obviously, as you mentioned, in the multifamily, there's a lot of different roles in things that you can do. You know, you can find the deal, you can underwrite, you can raise equity and asset management. You could do just mainly the asset management, or you could do a multiple of them. What was your role in that team?
Yeah, so this was like one of my first ones. So I wanted to be involved as much as I could. So I sat in on a lot of the asset management calls. I was going down there, more on a regular basis in the beginning. They have an all-star asset manager named Justin who, allowed me to do that kind of stuff. I was also a KP on the deal. What else? And then I brought in friends and family to invest in the deal. And obviously, too, I re-underwrote it, but I didn't do the initial underwriting on the deal. And those numbers, it's funny when you do the underwriting and you look back on your underwriting for that particular deal. I mean, my rents were below everything. I underwrite very, what we call conservatively. So I look at the numbers and I'm like, yeah, I could have escalated there. And that's why it increased in so much value. The times, but also how we underwrote it. And because I was looking at like a 15% IRR and, we're well above that.
Amazing. Iggy, could you share some of the personal and professional skills that you have to acquire by managing over 250 million in assets through Prostate Capital?
Yeah, so I mean, a lot of those assets are, the asset manager or the person actually running it is not me. And because that would be too much stuff to do because it's a whole bunch of different partnerships. Now, that being said, when Sam and Jon and I got together, and that's where the powerhouse happened, and that's where the magic happened, and that's where our synergy just came together because they are wonderful people. And we walked into this marriage together very, very slowly. We did several deals, and it took us till we're at the 7th or 8th deal to finally form this Lake City equity together. But the special skill set that you need is, I think it's really a mindset thing. It's, you number one always need to be learning. We call it Kaizen. I have our vision board right behind me. So, we call it Kaizen, but you always, no matter how much you know, you always need to learn more. Like I'm always trying to learn more. You also have to be optimistic. There's a lot of negative news right now sells, and it sells so much. You could turn on YouTube right now, look up multifamily, look up stock market, look up anything you want to see. You're going to see everything's crashing, the sky's falling, this, that, the other thing. You have to get past that because when everyone else is sitting on the sideline, that's when you need to take action. And that's why we're taking, massive action right now, and is to propel yourself forward. And I think that that's the most important thing is, you listen to both sides of what they're telling you, but always move forward and being able to pivot rapidly.
Yeah, no, that was actually part of going to be like kind of my follow-up to this, because with multifamily, you're able to scale, right? And I think that's one of the only assets that I know that we can scale like that. And the larger you go, the easier it's actually to manage. And I know you pointed out on that it's actually easier to manage these larger assets. Let's say if you had a bunch of duplexes, well, you have a property management, but you are going to be managing a lot of that because there's just not enough rental income coming in from those. But with the larger multifamily, you have your own leasing office, you have your own property management, you have asset management, you have so many different layers of people that are looking at that asset and managing that asset, making sure that it's performing. So that is incredible. I know you touched on it roughly, Iggy. So in regards to your partnership, right? We always share, whether it's our people in our database or our investors, how important team structure is, especially in the multifamily track record. It seems like you have found your team, you guys have done a bunch of deals with Sam and Jon. So tell us a little bit about how that came about, like you guys met, or how that's the partnership and why it works. Like what two things have made this partnership so successful?
Oh, I mean, I love talking about them because I love them as people. They take care of me when I'm down. I take care of them when they're down. It's like, it's a perfect relationship. And, what ended up happening was at the end of 2020, we all did a deal together, and we were, minority general partners on that deal. We came back to that site in 2021. We all met up in Lake City, Florida, and then we drove down to Orlando for a conference. I sat down next to them, and when you feel something, you feel it in your gut, and you're sitting there talking to them, and you're like, these are people I already know I'm going to be working with. I really enjoy their company. It just seems so right. And you just get that feeling, you get it in your gut, and you just know it's going to work. And it ended up being our first deal together was in Augusta, Georgia. And, our first where we were the main general partners was in Augusta, Georgia. And it was just, there were multiple setbacks in closing those deals because it was two different sellers, and there was the first rate hike in March of 2022. And those kind of combinations and how we worked to get it done and how none of us really freaked out. We just kept moving the ball forward, even though there were a lot of setbacks, and we had banks, one bank, pull out because they couldn't get funding, and we had another one. There was all this kind of chaos, but we got it done. And not only did we get it done, but that deal's freaking killing it. And it's doing so far above our projections that we just knew it was right. And so we continued doing stuff. And I think that the best thing that we all do together is we talk, we share our real problems. We share, if something's going on in our family, we're open about it. We share that so that everyone is aware, so everyone's on the same page. And also, I've never found people as hardworking as Sam and Jon are. I mean, they work their butts off. I mean, if I'm on the West Coast, they're working at all hours and they're getting stuff done. And, they have a lot, they have 3 young kids and they're running all over. And it's just wonderful. I feel absolutely blessed to be working with them. And they also shared the same values that I had, which was really important for investors, and putting investors first ahead of us. And I think that was the piece that I was looking for, was a group that would do that. And that's what they do. And that's what we do, is we put investors first. That's they're first ahead of us. And so.
Wow. No, and I couldn't agree with you more. I mean, we've met Jon multiple times now, and just they have something that is different than most people, something that you can trust, is a gut feeling, is something that just tells you, especially in this business, right? Like I know some of our mentors have said it, it's easy, partnerships are easy to get in, but hard to get out, right? And I think a lot of things that you've mentioned have been more about being able to have a relationship with those people, because you're going to have turbulence, you're going to have hard times, you're going to have issues, but is overcoming those together as a pack. And like you said, they push you when you're down, you push them when they're down, and you got to just go all push each other. So that's phenomenal.
Yeah, no, great. Yeah. One of the big factors about real estate is definitely partnership and growing together. So that's great. Thank you for sharing that, Iggy. I wanted to know what factors make investing in the market you are in attractive opportunities. For example, why do you like Savannah, for example?
Oh, we love Savannah. We love Savannah and love Charleston. I mean, I think one of the big factors that we all need to look at is how stuff gets into this country. Stuff, just goods. And how does it come from another country into here? Or how do we get stuff from here? I mean, I'm keeping this really simple, out. And you look for ports. And I think my biggest lesson was, I used to bike race a lot, and there was a port in LA that everyone was talking about during COVID. Even before COVID, I was there in 2019 and 2018, and sometimes I would get lost back there, not on purpose. I didn't want to get lost back there, and there were just tractor trailers lined up, and nothing was moving. All these tractor trailers are burning diesel, and they were just sitting there waiting to pick up stuff. Well, in Charleston, and also in Savannah, you got 2 ports, and they're expanded because, and not only that, you don't see those tractor trailers waiting. You see stuff actually moving. So merchandise is moving, so you can get product in and product out. What does that do? It creates jobs. The jobs then bring on more jobs. That brings on more jobs. So you got that. That's just the very basics of, Savannah and Charleston. And during COVID, when LA was backed up, those sites grew massively and stuff was being sent there. So I think that, especially, during those times was really important, but now it's really important too, because now the jobs. Also, offices, a lot of people are working, as we all know, we're talking in 2023, remotely or somewhat remotely. So you might spend 25% of your time in the office. Well, who wouldn't want to live in? So now there's jobs from the ports, and then you have 2 great vacation areas, and, both in Charleston and in Savannah. So now you have a great place to live, you have fun, you have good food, you have jobs. And now you have, like, in between Savannah and basically Augusta and in that area, you have this huge Hyundai EV plant opening up. And there's going to be more stuff opening up. And there's a limited number in Savannah specifically. You can't grow like that much more because you're either going to be in the marshes, there's no land to really build it up. So you can go up, but you can't go out. And I think that's the power of it. And then I was listening. It's ironic you mentioned it. I get very excited about Savannah and Charleston. and it's ironic you mention it because there was one podcast, and it was a Rich Dad, Poor Dad podcast that I was listening to in the car. Can't remember the episode, but it was about 2 months ago. You can pull it up, and Robert Kiyosaki will probably deny it after he said it on the podcast. But he's like, because he's more doom and gloom, especially with real estate. But he mentioned that he's looking in between Charleston and Savannah.
Wow.
And that gave me pause, and I'm like, did he really just say that? And I'm like, yeah.
That's great.
I've also heard Grant Cardone talk about Savannah.
Yes.
So I've heard him talk quite a bit about Savannah, how it's a good market people should be in the lookout for. And couldn't agree with you more. We got a chance to be down there, about a month ago, John? And we got a chance to experience what it was like to be in Savannah and how folks just love it. Like people that have moving in from California, New York, Boston, New Jersey, California, and there's people are moving in the hundreds, right? And then, like you mentioned, you add the jobs to all this, the weather, right? The ports, everything just it has all the right features to a market that you're looking for. So no, this is great. This is exactly kind of one of the why we wanted to have you on, because especially for us being Canadian and showing folks why we love Savannah and why Savannah is such an exciting market. It's much better when it comes from other people like yourself, especially that have been so successful in the industry. So as we're talking about it, because we're talking about all these different markets that are kind of all nearby, Charleston, Savannah, Augusta, wanted to ask you a little bit about property management, in-house property management. And I guess kind of one of the reasons we wanted to mention this is because a lot of folks may get carried away with closing deals, but not everybody can execute on the business plan, especially when you're outsourcing that to a third-party company. Now, you guys have actually went in-house property management. Tell us how much of a difference that has made, and tell us why you decided to go in-house property management for folks that may not know.
Yeah, I think that the biggest key is the speed of execution, and also that you're considered first, because it's only you taking care of you. And I think that that's the most important piece. Is I have several other deals with third-party property management. A lot of them are doing great, but there's always a struggle. There's always red tape. You tell them to renovate a door or, an apartment, and the costs are sometimes totally different than what you had in mind. There's all sorts of things that come up. That's why we knew it had to be done to use our own property management. And we first used a consultant to do that. And I think that was the power. That was the spark that made it happen, because we got to see it firsthand on the execution, and it was so much different. It was so wonderful. Yeah, there's a lot more work to be done when you run the property management, more stuff, just stuff in general that needs to be done, that a lot of people don't see behind the scenes, hiring, firing, all that other stuff. But the payback is huge, and it's so much better. So, I mean, it's night and day. When I compare what happens at those other properties, how I have to call multiple times to get in touch with the property management company, when now, we just had a meeting this morning. And so it's like totally different.
Absolutely. I can definitely agree that definitely sets operators and teams apart, and it's extremely important. And building on that, the asset management team is often regarded as the backbone of multifamily investments. How does Lake City Equity approach asset management, and what specific practices or approaches have you found to be the most effective in ensuring the success of your projects?
Yeah, so we have the property management side, and then you still need an asset management side. And so that asset management side handles a lot of the back end stuff, like dealing with, the banks and stuff like that, to do that kind of stuff. The advantage, though, is that it's streamlined, because it's a lot of overlap and a lot of stuff that, your third party property manager should be doing. We just now filter that over with the asset management. So it just merges beautifully, and then stuff gets done more efficiently, or stuff gets done. I'll be honest, with a lot of third party property management, there's stuff that's missed, and now we can handle it. And, there's oversight with the asset management side.
Absolutely.
Did I answer your question, or I talked about it?
And I think, just in my opinion, I think the reason why your own in-house property management is so important, like you mentioned, you are their client. Like you're not just another number. Where, let's just say you have an asset in Charleston and you outsource it to a third-party company, but then they have all these other properties that they're managing and they're leasing up. So what's going to make your property a priority over another,
Exactly.
So does that happen, right? They have multiple listings. What's going to make yours different than theirs? Why should they put more effort on you? So I feel like having that in-house property, man, have that infrastructure, that foundation is crucial. We were supposed to have a guy on our podcast yesterday. We had to reschedule, but he's been able to build a $7.7 billion, multifamily essentially portfolio. And how he was able to do that is exactly like you mentioned. But what he did was he actually bought property management company. I think he bought 2 or 3 companies with like 10,000 units or something. And then he started acquiring assets. But because he had the infrastructure, he's able to scale. So I think I can definitely see a lot of relation from what you guys been able to do. Being able to get to $250 million in a couple of years. You haven't been in the multifamily sector for like 10, 15 years. This has been over the last, what would you say, 3 to 5 years or so?
Yep.
I mean, that's really impressive. That's like, the economies of scale that you've been able to do is phenomenal. And I think part of that has to do with the property management, in-house property management. So that's phenomenal. And I think something to add to that, I don't know if you could agree, but when you have your own in-house property management, when you go in and view in other properties, you also can bring them along with you. And you guys already know exactly what the business plan, what you can get for rents. And I think we noticed that in Savannah. Would you say that's correct?
Oh, without a doubt. And what I forgot to mention, what happens with a lot of third-party property management, sometimes there's different thresholds where they have to get to. So, and sometimes it's as low as 92% that they consider that really stable. Once they get your property up to 92, sometimes if you're lucky, 95, they take their best people that are doing great and they take them from your property and move them to another property. Or that's hurting, that's only 85% or 80% occupied, because then they want the best people over there. And you'll see that a lot with third party, as opposed to us. I mean, we'll get it as occupied as need be. And then once it's there, then we raise the rents. And so we have, and that's, I think, a big part of it. And also the caring we have, you have your owners that know the people that are actually working at the property and know the leadership of the property management company. And that adds a lot of value too. So, because we want to get back, and that's, that's something that we strive to do.
Love.
So,
No,
I like that.
Very powerful. I know you mentioned Iggy, kind of going back to what you mentioned earlier. You said, no matter what the market is, essentially, you guys are still buying, you guys are still active. So for people that may be listening, they may be sitting on the sidelines. So just so you know, you are actively acquiring assets in 2023.
Yes.
And
I'm still passively
in
investing. Yes.
Okay.
Yes.
Okay. And how have you been able to mitigate some of the risk with the new interest rates, the market? What have you seen that has worked for you lately in terms of like just any sort of ways you're mitigating risk when it comes to acquiring multifamily currently?
Well, I think the best thing is we have our own property management company. That's number one. Number two, we're buying things, to me, at a huge discount because we're basing it on cash flow. So if someone, and this is what still kind of is surprising to me, if in 2021 or even 2022, in the beginning of 2022, if you were willing to pay X for that deal, and now you can pay 0.8X for that same deal, it makes sense to buy. You're already buying it at a discount. And when do you want to get involved? And it should have been yesterday in real estate. So if that deal is cash flowing at 0.8X and it would have cash flowed at X at the full value, why wouldn't you buy it? And why wouldn't you get involved? Like, I understand that, treasuries and, if you invest in treasuries, which a lot of us, probably putting some into 3-month treasuries in the United States, and you're getting, 5% or 5.5%, seems like it's great. So you pay your taxes. And, you end up, a lot of our individuals are high net worth, and not just high net worth, but the high salary paid individuals, and a lot of dentists and medical professionals. And they're already at a pretty high tax bracket. So that income that they're making, they're going to pay substantial taxes on it. So your 5% or your 5% your money market, you're probably getting 2.5% after taxes, 3%, if you're lucky, as opposed to these deals, you get, what's your most important thing for a lot of individuals is capital preservation, is holding on to that capital and holding on to that value. You don't know if your bank's going to shut down. You have more than $250,000 in there. Are they going to cover it? Are they not? I mean, these are the kind of things that I think about. That's number one. Number two are the distributions you get. And then number three are these freaking huge tax benefits. You take advantage of this 80%, depreciation. This is in the United States. I know we're talking about Canada, but those three in the United States are really powerful things. And those are things why I always go back to multifamily, because I look at everything else and I invest in other things, but I always go back to multifamily because it freaking makes sense. People need a place to live and they'll pay for it. And if you can provide value to those residents, they're going to pay more. You take care of them when there's a service call, my faucet's leaking, my shower's not working, whatever it is, my hot water's not working, and you take care of them that day and you respond to them and you're nice to them, they reward you by paying more in rent. And you're helping them out, they're helping you out. So I mean, to me, it now is a great time to invest in multifamily. And that's why I continue to do it and continue to invest in it. And so.
Absolutely. No, you know what? Capital preservation and everything you mentioned, you hit it right on the nail. And especially not even being able these days to completely trust your bank if you have a very large sums of money in there, as we saw earlier this year with the closure of some banks down in the valley. So no, absolutely, Iggy. I wanted to ask you a little bit about your book. I'm excited to hear a little bit about it. I was talking to Jeff about ordering a copy and reading it in the next couple weeks. Can you share a little bit more about that book and how that started and the story behind it?
Sure. I just wanted to share a story of my story. To other dentists and medical professionals to show them, hey, if I can do this, you can do this. And I tried my very best to make it really simple. And, to take, terms like IRR and explain them as simply as they possibly can be. Yes, you can Google search it. Yes, you could put it in ChatGPT now and, decipher it and explain it like how a fifth grader should explain it or understand it. But that was the goal of the book. And it was really the background of the story of what you just heard on this podcast. You don't even need to buy the book. You heard it on this podcast. This is the book.
Like and subscribe.
Right.
No, that's phenomenal. And I think you have found a niche, and I think a lot of us find a niche. In your case, being dentists and high professionals. So tell us a little bit about why you're so passionate about that. I know you mentioned it earlier. Why are you so passionate about helping other folks that are in the industry? I know you mentioned it, but just for the audience.
Yeah, and this is where another part of the why is I saw them take a huge hit in 2008, and I know this is such a better vehicle because you have more control. I mean, you could reach out to me, you could reach out, especially my dental friends. I mean, they'll text me and it's right there. It's like, it's such a powerful thing getting those distributions. The first time I got them, I just had this huge smile on my face because you're like, this is real. So you're getting those distributions, you're making money on the back end. I mean, it's like you're getting it both ways. Oh, and you're getting these tax benefits. And like I said before, your capital preservation, it makes a ton of sense to me. And I think my goal is to get as many dentists and medical professionals involved in this because it adds so much value to their life. But they always ask me, can I retire on this? And it's like, how much are you willing to invest? And how much, how long are you willing to do this? Because this is not a 1 year get rich thing.
It's not.
Realistically, if you really want to live off your cash flow, this could be, 10 to 20 years. And then you're going to be so far ahead of everybody else. And I'm not trying to do it as a comparison, but when I say everyone else, I mean yourself if you went the standard way with the stocks and the bonds and the other stuff that your advisor would tell you to do.
No, you nailed it right on. Me and John actually just did a webinar a few months ago where we basically kind of said exactly what you mentioned, that if you were to invest 100,000 and you're able to multiply that money over a 3 to 5 year period, over, I think we were at year 12 or 13, that 100,000 has now essentially turned to over $1 million. You invest $1 million at about 8 to 10% cash on cash, you're over $10,000 of passive, like true passive income. And it truly was a vehicle, and like showing, obviously just a diagram of how it can be done, whether it's 10, 15, even 20 years. Most people work 40, 50 years and retire like 70 or 60. Like you can still do that, but you will have a true nest of cash flow, net worth and all that. So you nailed it right on. Okay, so we're gonna get to some fun questions here. We actually gather a few questions. So we usually will do these fun questions towards like the end of the podcast here, and we definitely appreciate experts and everything that you've been able to share. Definitely, I know our audience is going to be getting a lot of value. The first one is, if you could go back and give a piece of advice to your younger self, what would it be?
Oh, that's a good question. I think to be more entrepreneurial at a younger age. Like I already, I started a little car waxing business, and to fail more, to have more setbacks, to learn faster. And obviously get involved, and everyone will tell you this, but get involved in multifamily sooner. I only wish I did this, right out of college or even before that.
Absolutely.
And every multifamily investor will tell you that.
Couldn't agree more. And I think part of being an entrepreneur kind of relates to fail, I would say, right? Like obviously as you become an entrepreneur, you're going to fail at, I don't, this wasn't written down, but just a question for you. What do you think that people are so scared to fail? Do you think it's just, the environment we grew up in, like you fail in school, you're considered dumb? What would you say is one of the reasons why people are so afraid to fail?
I think you hit it. It was me. It was I had a lot of setbacks in school, and so I was always scared to speak in front of people. I would get nervous and anxiety until I realized other people felt the same way. And I was like, why am I not sharing my voice if, and for the same reason? And so I think it's because you're scared to fail, because failure was looked upon in school as a bad thing. And it should be a good thing, especially if you tried hard and you put in effort and you have a setback. It's a learning experience. When you get an A, like back, you don't remember any of that stuff. It's when you got a B or a C and they marked up your papers back then. I don't know if stuff is probably all online now, but my daughter will tell me later. But they would mark up your papers and you would have to read each one of those red lines. And so if you view that as value, I now do, that's when you'll grow. And so I continue to, if I make a mistake, I want to learn from it. And, what did you fail at today? That's what I ask myself. And if I didn't, then I didn't try hard enough.
Powerful stuff.
And Iggy, lastly here, if there's one book that has had a profound impact on your life or career, which book would it be and why?
All right. So usually it's Rich Dad, Poor Dad, because that's the one that, really made an impact. But, I like Napoleon Hill, and when I was at Rod's boot camp, Think and Grow Rich. Mm-hmm. This is probably the 5th time I'm reading this, and it gave me great reminders on what to say to yourself and how stuff can, when you visualize things, they really do come true. Always wanted a second house in San Diego. I'm standing in it right now.
Love it.
Because we visualized it, we saw it, I put it on my computer, and then nothing's going to be exact, but it's pretty close.
Congratulations.
Thank you.
I know you've worked hard, and I couldn't agree with you more. I think every time you read like Napoleon Hill, like Think and Grow Rich, I've read it twice. Every time you read it, you get different things from it. You actually dissect the book a little bit different each time, which I find it's really interesting. That's a great answer, and again, congratulations on all your success. Last question. I know this actually wasn't here. That was actually the last question we just had, but one more question, because I know we could keep talking forever. What is next for you? What do you see? Any big goals within the next 10 years? Any big goals, whether it's real estate related or just personal? Anything that the audience should look out for you in the next couple of years?
A third house in San Diego.
Third house. No third house. Yeah, that's too much. Yeah, you want to stick. I'll stick with multifamily, not residential houses. And
there you go.
Too much work that you have to take care of yourself. And so, our big goal as Lake City Equity is to get $1 billion worth of assets under management, and that's our big goal. Sam and John will tell you 5 years. That means 3 years.
I love it.
So,
that's really interesting.
That's funny enough. Yeah.
That's literally our goal as well. So, we're very excited to potentially do some big things in the future. That's literally our goal. We have it as a 10-year goal because we wanted to just kind of give ourselves, a good amount of time. Right. But that's really interesting that was your answer, because that's literally our goal. So that tells
Love
us
it.
So that's pretty much it. So thank you so much, Iggy, for being with us. We'll just kind of wrap it up here. So again, thank you. Your journey is truly remarkable, and being able to manage over 250 million definitely is something you should be proud of. I know you guys are still looking to strive for more. But definitely, your commitment to leadership development have been truly inspiring. We definitely appreciate it. And your insights into asset management, property management have been remarkable. So again, thank you so much for being here. I know our listeners have got tremendous value. If folks want to connect with you, Iggy, what is the best way for folks to connect with you, network with you, talk to you? What's the best way?
Oh, reach out to me, Iggy, IGGY, at lakecityequity.com.
Okay, perfect. And we'll make sure we'll put those in the show notes. No, we're again. Thank you so much, John. Anything you want to add?
No, it's been an absolute pleasure. Definitely an episode for the books. I hope everyone enjoyed the episode, and Iggy, an absolute pleasure again. Thank you so much for being here.
Well, thank you guys. I really appreciate this. I'm humbled to be on this podcast, and I just really appreciate the opportunity. So thank you.
Thank you. Okay, so thank you to our listeners for tuning in to another episode of Passive Investing in US Multifamily Show. Please don't forget to subscribe, rate, and review our podcast. And stay tuned for more inspiring stories and valuable insights in the world of multifamily real estate. Until next time.